It's time. Okay.
It's about that time.
Hello, Shreveport, and all of our other viewers from the rest of the world. I have been out for the last couple of these. Most recently, last Friday, I was out because I was getting over about with COVID-19 and
Sure, it's not 21.
Omicron. Yes,
You're
whatever.
You're becoming a transformer.
So, actually, it wasn't all that bad. I drank after somebody, I think, and she came down. We were having dinner together. She came down with a fever the next day, and I thought, oh man. And then I started getting this kind of stuff, dripping nasal congestion. Woke up the next morning, felt really weak. Went and got tested at Quick Care. There were no tests that I could find anywhere in Shreveport. I was told not to try, so I went to Quick Care. It took 3 hours, and then I found out that I had COVID. And they had told me it would only take an hour, and when I complained about it, they said try going to the emergency room. It'll take 12 to 14 hours. So I was like, thank you. Anyway, I've just lost my voice a little bit. I actually feel terrific. I only felt bad for one day. My colleague William is on Interstate 20, heading over to more West Louisiana, and halfway across. And so we've got our colleague Wesley Roderick here with us. He's our web design, social media marketing expert, advisor in training. And we're going to talk about, we've got a future Jack and Bill show forthcoming about, we'll have to, due to confidentiality reasons, we're going to have to change the names or do something, but we're going to have
not use names.
Yeah, we're going to have a show where we talk about absolutely hysterical times and stories with client happenings or occurrences.
Yes.
And I've got some really good ones. These have to be told. Some of the clients are now deceased. But, well, what's going on with the markets? You know,
before you do that,
okay,
because you already gave me freedom to ask any question.
Okay, go
I
ahead.
want.
Fire away.
If the moon was made of spare ribs,
okay,
would you eat it? If the moon was made of spare ribs, would you eat the moon?
I love spare ribs.
Exactly.
Yeah.
So you would eat the moon.
Yeah.
All right, cool. That's it.
Oh, okay.
Welcome to the Jack and Bill show.
Well, let me give a little.
Yeah, give a
Let
rundown.
me give a market rundown, and then we're going to get into this. Picked up this morning's Wall Street Journal and went through the numbers, which I basically already knew. S&P 500 through yesterday was down 5.9%. The Dow Jones Industrial Average 30 stocks down about 4.5%. NASDAQ Composite down about 9.5%, and the NASDAQ 100 about 9%. That's through yesterday. So today, and the Vanguard Total Bond ETF I looked was down about 2%. So that's a pretty good reflection or indicator of what the whole bond market's doing. That's, safe money. That's down, 2% so far this year. The Dow Jones Commodity Index, after being up, in the around 20% last year, is on fire again, up 6.49% so far this year. West Texas Intermediate leading the way, up about 15.5%. Nat gas, gold, and silver, and all those commodities are up a little bit as well. But today we come in, the last couple of days, Wesley, I've noticed, it seems like the buy the dip mentality has momentarily left the marketplace, and I think largely due to fear. And where's the fear coming from? But anyway, so Yesterday we started out in the green and then sold off at the end. Started off way down today with the futures being down overnight. Rallied back to positive territory and then sold down sharply this afternoon, where the S&P, Nasdaq was down, call it 2.75% today. That's a pretty healthy downturn. That now, Wesley, has the market officially in correction territory, defined as a market pullback of 10% or more. The S&P 500 down almost 2% today, is now down, call it about 7.8. That's not correction territory after being up nearly 30 last year, but it's getting close. Russell 2000 smaller stocks down nearly 2% today. The Dow down about 1.3. West Texas Intermediate declined today to 84.83, but again, it's up, call it 14.5% this year. Cryptos were down sharply today, and even then, gold had a little bit of a give back at 18.33. So that's got us, what's gonna happen when we come in here, next week. Last year we had this thing where we would climb. We'd have an up week followed by a down week, then an up week, then a down week. But we were going incrementally higher every time. The market made many highs last year.
It would take 2 steps back and then 3 steps forward.
Yeah, exactly.
It was doing a waltz.
Yeah, there you go. So okay, Wesley. Well, what are we gonna discuss?
Since it is a hot subject matter, and I asked Bill this last week, considering that a vast majority of my generation has not really ever experienced inflation, even. Like, we have not seen anything like this, like where prices are just going through the roof on just random household items, everyday things from gas to milk. And so, you guys being of a older, wiser generation and experienced this during the Great Depression.
Not quite.
Seeing if you were listening. But having seen things like this before and being a person who studied out markets and trends and things of this nature, I know this isn't one of the questions we had an idea, but I think it's a question that could be answered by a lot of people that would be watching on social media.
Okay.
What can you tell us about this? Because, is it time to freak out? Is it time to just stay the course? You said the buy the dip mentality is kind of leaving everything right now. So, what would you suggest in this?
It really comes down to one's objectives. But first off, generally, Wesley, every time when you get into a new year, and even in the fall, you'll wind up starting to see a rotation out of certain areas and into other areas as people want to front run the next year's good ideas. And I think it started a little bit late this year because the market went up so much last year that if you sold at the end of the year to reposition those assets, you were likely realizing hefty capital gains, which you have to pay taxes on, by April the 15th of this year.
Right.
So it was a little bit different, but I think that, just getting back to your question, you really have to remain calm, and I think that for a lot of these young people and a lot of people that are into social media marketing, or social media rather, they haven't lived through. I think of the young brokers or financial advisors that are in our business. I mean, they've never lived through. Well, you have to go back to the subprime crisis.
Yeah, that's what I was thinking.
Subprime crisis, the S&P 500 fell about 58%. And then we fell roughly 2% with the tech bubble in 2000. But we it took 3 years to get to new highs in 2000, in 2002, 2003, in there. Coming out of the subprime crisis, we came right back too. But none of these young brokers or advisors or market participants, we have a lot in the do-it-yourself community that at the margin, people that have decided to forego advice in the last few years has been growing each year because it's been too easy. Right. When that happens, you have excesses develop, and the market corrections, like the NASDAQ we just said is in a correction. Market corrections are both good and healthy, for the marketplace. So we think if you started out the last year, say 50-50 stocks and bonds, and you did not rebalance, that portfolio looks more like 75% stocks and 25% bonds now, because bonds lost a little money last year. I think they will this year too, unless you're in the right ones. And then the equities ran up 30%. So that portfolio, if it hasn't been rebalanced, it needs to be rebalanced, and it's not too late. Okay. It's not too late at all, and we're actually doing some of that. So, and the major market indices. I mean, I think Bill talked about this on the show last week. I think that 30% of the S&P 500, which is a capitalization weighted index, that means that the larger market capitalizations are larger companies. Market cap is share price times the number of shares outstanding. There's about 10 names, the top 10 names comprise 30% of the index, which means that the index is likely going to go the way of those 10 names. So like conversely, you could own an equally weighted NASDAQ 100 or composite or S&P 500, and we actually believe that's going to do far this year, because we've had this phenomenon in place with indexing and these very large mega caps. Generally speaking, the valuations have outrun the weighted average market participants, and we've got some of the PE ratios have gotten especially high with in places like tech and NASDAQ names in general, some of the lower dividend paying type names. So growth
basically,
stocks.
Because the names that are very recognizable to the common person, that are going to be weighted in your larger index funds, they're going to be driven by those bigger names, and so if those names suffer, so the whole index is going to basically suffer.
That's exactly right.
Okay,
that's exactly right.
Why would you say that the market is struggling right now, though?
Well, that's the big question, and I think it's really easy to answer that. And I think that a lot of this selling came about later than ordinary because of, again, people not want to necessarily dump a bunch of capital gains on themselves at year end and defer it into this year. But here's the reason, and you could break this up into a two-part reason. There appears to be all kinds of worries and concerns about inflation. Is inflation peaking, or is it here to stay? Inflation is defined as basically it's just a general rise in prices, and we had CPI inflation ran something like 6.8% last year, and PPI inflation, that's the consumer price index, and the producer price index, which is more wholesale prices, was up a little bit, more than that. And I've heard that 6 months ago that inflation was peaking. And here we are, I look at the Dow Jones Commodity Index in today's Wall Street Journal, and almost everything has lost money seemingly, except for, here you go. The Dow Jones Commodity Index is up 6.5% year to date, driven by energy and things like that. I mean, food, agriculture, energy. So I actually think commodity price inflation is 20% of the game, and the biggest part of that, or 65 to 70% of it, is the cost of labor.
Yeah.
And we still, it's in today's Wall Street Journal that there's labor issues right now that are temporary because of Omicron.
Right.
I mean, think restaurants and services and things like that. But we've got a secular problem with labor because we have an aging population and we have people leaving the workforce. So if you can't find the laborers, ultimately you find them by bidding up the wages and salaries.
But I mean, in that, and you will anyways if I'm wrong, so you'll tell me, is you're not finding those who are leaving the workforce in restaurant work for the most part, or service work. Could we also look at the fact that some of these people realize that, like, they're maybe become a little too comfortable and dependent upon when they were getting unemployment benefits, and that was equaling higher than what they were making on a weekly basis.
That's true. And Bill and I were discussing this earlier today, because he seems to think that that's over or nearing an end. But so those are government payments to individuals to stay home, and in my opinion, that has ravaged the service and manufacturing industries. And then you have things like the child care tax credit, which I know of very affluent people who are getting $500 or $600 a month per kid. I mean, and I'd be very much okay with means testing on that, but do we need to have all this stimulus, and that is causing people to stay home and not work?
I mean, now you also have where just in Shreveport local news here, where they're working because there was a grant given of $500,000 or something like that, where they're trying to create like a universal basic income.
Right.
And so I mean, that's gonna help encourage people, and then and
encourage people to do what?
Not have a regular 9 to 5. But there's very specific criteria for that to be met. I think the other side too is while people were out of work, they were finding alternative means to work, to make money.
I think
a little bit more entrepreneurs coming out of people,
or the black market economy is alive and well. So okay, so that's part one to the question is inflation? First off, the Fed told us to stop using the transitory word. So
don't use it.
If the
They'll
Fed
get mad at you.
if the Fed admits that we have inflation, you never want to fight the Fed. That tells me that the Fed is about to do something, about this inflation. And that means we actually do need higher interest rates. Interest rates at 1 or 2% or less is not good for our aging population of people that live on a fixed income. Now, it's going to be painful to raise interest rates, but the Fed uses the Fed funds rate to monetary policy. They'll raise the Fed funds rate to try to slow down the economy or combat inflation, and they'll do the opposite of that, when the economy needs stimulus by reducing rates. We've also developed this $9 trillion balance sheet at the Federal Reserve, which they've already announced that they are tapering their quantitative easy or Treasury and mortgage-backed securities buying programs, and that's likely going to be curtailed to nothing by March. But even still, they're still expanding the balance sheet, which is stimulative in a way. And then when they're done with that, there are people like the CEO of J.P. Morgan Chase, Jamie Dimon, thinks that we could easily have 6 interest rate hikes this year. And the market, so I think the market, Wesley, is telling us we don't want that.
Right.
We don't want that. Will the market? I'm not sure that the Fed is really going to be able to take necessary steps to thwart. I'm in the camp that inflation is here to stay for a while.
Right.
And I think that we've created some major issues with that. So I think that then that's gonna translate into needing to make some asset allocation decisions that favor things that will do well if inflation continues.
So
yeah.
we've identified a litany of issues and problems and quandaries and all this other stuff. What's the solution? Abraham Lincoln said you should never point out a problem unless you can also point out a solution. I read it on the internet when he posted it.
What's the solution?
Yes. What's the like?
That doesn't.
What
doesn't
should we be
look
doing?
like a question that I gave you.
You know, it
for
says
the-
what should we
for
be
the-
doing? What should we be doing?
Okay.
Okay. I just reworded it. You said I had liberty.
Okay.
It's like
I think
interviewing the government.
I think that the solution, you know, I think that we need to have freer markets in the long run, Wesley. We've gotten to this place.
But by solution, I mean, and I do mean actually more of like, what should we be doing in order to ride this thing out? Not the solution for the government.
Oh,
Unless you wanna
okay.
run for
I probably misunderstood your question.
I misstated it.
No. That's okay. I mean, because listen to this. This is the fiscal state of the nation is such to where, you know, in 2019 we ran a deficit to GDP of 5.2%. That means the budget deficit. That means that the government outlays far exceeded government receipts. And so the deficit, when it goes net, when outlays outweigh government tax receipts, you have a deficit. And then we compare that deficit to GDP, which is gross domestic product, which is the size of our economy, or the sales of all, you know, goods and services. Okay, that deficit to GDP skyrocketed from 5% to the largest I think this nation has ever had in her history to 17%, as we had a deficit of 3.1 trillion. And take that back to the last year under George Bush, 2008, it was 458 billion, which was the largest deficit since 2000. And the following year, with the beginning of the subprime crisis, President Obama inherited such a problem that they had to, you know, provide stimulus and so forth, and the deficit jumped to 1.4 trillion. Now, 1.4 trillion, I mean, that's way less than half of the 3.1 trillion. So essentially what we've seen our debt to GDP climb to, from only 68% when I mentioned Bush's last year, to over 150%, you know, right now. There is a crowding out effect with all that, and there are some people would call this conspiracy theory, but
we like to use the word speculation around here.
Okay, so here's speculation. Although, you know, I read Harvard professors Reinhardt and Rogoff wrote a book entitled "This Time is Different." That's what everyone says, but we can do it this time because this is different, and this is different, and this is different.
Right.
And then ultimately you have a collapse. and everyone says, any teenager could have figured out why that happened. So it's, but the solution, and I will touch on that since I misinterpreted your question, is that we've got to get to where markets determine market prices. The bond markets freely determine bond yields and prices on their own without Federal Reserve or government intervention, call it, and then all this stimulus. I mean, I actually think it's got an ugly end to it, but what is the solution for us that we're seeing? Is that's what you're asking? Is that right?
Let me tie it into this.
Okay.
Because this is what's most important that we communicate.
Okay.
As far as a solutionary focus, I like that word.
Okay.
What are we doing for our clients here at Eagle?
Yeah, there you go.
I think that's the best question right now.
Okay. And I'd go back to the investment process. So if you're someone who's nervous about these markets, and let's just say this, every 2 years on average you have a 10% correction or more. Okay, you could say 2000 and 2008 were the last, 50% corrections. 1987, same thing. We had a 27% down day in one day. That was a collapse in one day. So 2000, the tech bubble blew. 2008. I think that there are some securities right now that are highly vulnerable. We at Eagle really don't want to be in those securities or have a whole lot of exposure to them. But this is the solution for our clients. Give us a phone call if you'd like to do a review. But go back and, it's a great time to take inventory of your life. What are your financial goals and objectives right now? Is the asset allocation that you have, or the makeup or the slices of the pie, this slice in stocks, this slice in bonds, this slice in alternatives or commodities, is your asset allocation consistent with your long-term goals and objectives? And if that's the case, we've rebalanced here at Eagle. We continuously do that when we get out of alignment, and we have been, trading out of some of the high-flying stuff in favor of. I think there's a sub-question that goes with this, Wesley. Like, if you look in today's Wall Street Journal, you can look at the mutual fund section. It says the Vanguard Admiral S&P 500 Index Fund is down 5.9% year to date. Went down almost another 2 today. But look at Vanguard Growth Admiral, down 10.4. That went down at least another 2% today.
How can you read that thing?
So that's down 12.5. And then, look at this. Vanguard Value Admiral is only down 1.3.
What power are your glasses? I couldn't read that.
Okay, so growth is down 12% and value's down 1 or 2 or 3. Call it 2. We actually have a value bent here at Eagle, and so our clients are holding up way better. We own some commodities funds that utilize trend following in the commodity space that have done very well. Some of those funds are up so far this year, with the market, down now. NASDAQ market down over 10. We have very little NASDAQ exposure, and we don't have the high-flying NASDAQ exposure.
I mean,
so
you could say, and to a degree, without giving too much away of our cookie recipe,
yeah,
we've done unorthodox things.
Unconventional.
Where the vast majority of investors are going this way we're kind of like this a little bit.
Yeah.
We the helm is tilted a little, like 3 degrees to the left, and but we're riding along similar, so we're able to see what's going on if we want to get onto that avenue, but we're going in a slightly different direction.
Yeah, I do. I do think that we're at a juncture in the marketplace that could be really termed like a sea change, and that is, I'm just going to say this. This is my stinking opinion, but the two things that I just said, Wesley, I'll tell our viewers this. If you take the S&P 500,
He's drawing a diagram for those who can't see.
you probably can't see this,
No,
but
they
if you
can't.
take they can't see that. Okay, if you take the S&P 500, which is the 500 blue chip stocks in America, and here's the 500 of them stacked on top of each other. Right in the middle would be the 250th one. So if you look at the PE ratios, that's, if you have a $10 stock that earns $1 per share in earnings, it has a PE of 10. So the lowest 250 PEs would be termed value, and the highest 250 would be termed growth. So growth, it's okay. We like to own growth and I wrote value, growth and value stocks. It's okay to own a growth stock. They oftentimes make money in times of recessions or in times when cyclical stocks aren't doing well or the business cycle is not doing well or in recession or slowing. But it's okay to have growth as long as you don't pay too much for that growth. So there's another factor called the PE to growth ratio or the PEG ratio. And if you can ever find them less than 1, that means you're paying very low prices, for growth. So you want to have as much growth as possibly as inexpensively as possible. And in the value category, you're going to have much more in income. So we just said, call it growth is down 12% this year. Value is down 2% this year. There has been an enormous divergence the last 10 to 15 years where growth has way outperformed value. Yet historically, Wesley, if you go back to 1926, value is off the charts better than
You were playing
growth.
football then, weren't you?
My grandparents were living back then. So we have more. As the year progressed last year, we really developed more of a value bent, and then we have exposure to things that should do well if inflation continues also. And then in the bond market, if interest rates go up, there's an inverse relationship between bond yields and bond prices. And so we own a lot of adjustable rate bonds, or we own shorter duration or shorter maturity bonds where we don't care if there's volatility. We're just going to hold them to maturity. And it's interesting because William left me with a chart yesterday that shows, I should have got you to put this on there. It shows the relationship of the S&P 500 PE ratio to the 10-year U.S. Treasury bond yield. And when bond yields go up, PEs come down because a company's not. Here's some technical stuff for our viewers. Any asset is worth its expected future cash flows discounted back to the present at the weighted average cost of capital. So let's just say that you're a company and your cost of capital is all debt. You don't have stock and retained earnings and preferred stock and all this other stuff. All you have is debt. So if you're going to discount the value of that company, you're going to discount those cash flows back to the present at an interest rate factor that's in the denominator. Well, if the value is equal to the expected future cash flows, the summation of that over the discounted rate, or call it the 10-year treasury rate, and rates go up, that company's worth less. And here's the easiest way to see that math is, let's just say that company has variable rate debt to fund their operations, and it goes up. Yeah. So their cost of doing business goes up. Yeah. And that's a grossly simplified way to look at it. So, but the stock market is worth less with rising interest rates. So that's the big fear thing that's hit the markets is
this whole you've been talking, and I've been just sitting here thinking, looking at this, this globe. And the thing is like many times we want to look at the market as like if this is a crystal ball and we can tell the future. We know what's going to happen. But really, it's not looking at it from a crystal ball perspective, but it's actually literally just changing the perspective.
Yeah.
Because if you're looking at something and you see it going in one direction, we'll look at it from a different direction and you can see what's growing. If something's going down, something's growing.
Oh yeah, that's exactly right. And I think there's always a trade, and there's always a place to be, and we are students of the market every day to desperately determine which side of the trade to be on, or better, where to be, or how to refine our slices of the asset allocation pie so that we're maximizing returns for a given level of risk.
Right.
Okay. Yeah.
I mean, I think it's it's part of my favorite joke is today's Wall Street Journal has yesterday's news.
That's exactly right.
So
that's
on to
exactly
your favorite part of the show.
Yeah.
What's happening in sports? I think the Lions are going to go to the Super Bowl.
It's time for sports.
It's always time for sports, Jack.
The Lions, unless you're talking about rugby, or there are no Lions left in the NFL.
The Detroit Lions don't exist anymore? Where have I been?
They haven't made it. So, we have 3 games tomorrow. Bengals, Titans. Bengals have former LSU national champion Burrow at quarterback.
Yes.
That's going to be an awesome game, against the Tennessee Titans, who have Derrick Henry, star Alabama tailback, returning after a broken foot for the first time. I think that game comes down to the wire. I want the Bengals to win because Joe Burrow is going to be throwing to LSU receiver Jamar Chase.
But who you want to win and who do you think is going to win?
I
feel like those are two different things.
I think the Titans are probably favored by a field goal, and any of these teams. 49ers and Packers. The 49ers knocked the Saints out of the playoffs, and then they beat the Dallas Cowboys last week. The Packers are going to win that one. Buccaneers, Rams. The Rams with Stafford at quarterback blew out Arizona. That was unforeseen. But you've got the GOAT. Do you know what a GOAT is?
Greatest of all time, Jack.
You've got the NFL GOAT, Tom Brady, 45 years old.
Hold on. When did you learn what the GOAT is? And by the way, if by chance the Niners can tap into the spirit of Montana to Rice, they will take that thing.
There you go. I think Joe Montana, some people regard him as the best ever. It's a new era now. Then we've got Bills and Chiefs. And that's all the games. There's 2 games tomorrow and 2 games Sunday. Rams Buccaneers on Sunday, I think. Yes. And then Bills Chiefs coming, and that's going to be really good. The Bills really strong team the last few years with their new quarterback who likes to run, and then Mahomes at quarterback for the Chiefs. So we've got, this is the best weekend for NFL football in our view because you've got 4 fantastic games and the best 8 teams left, and none of the teams that I really care about are remaining. So it's a good. That's the only thing any good on TV in terms of sports, in my opinion. I don't really get into college basketball until we get to March Madness. So.
But Knight Rider's back on Netflix.
Oh, Knight Rider's back on Netflix.
Yeah.
Okay, I'll have to check that out. Yeah, what kind of car did he have?
Wasn't that a Trans Am?
Trans Am. I think it was a Trans Am.
Yeah. Just remember, Kit happens.
Kid happens.
Exactly.
Oh my gosh. Well, I think we've kind of given a little flavor for what's going on, and we would just say we welcome a phone call or questions or comments. Come see us. Take a look over your portfolio, your asset allocation, and make sure that you're positioned in accordance with your goals and objectives. And if you haven't had a professional look at it, that's a must in my view, because I think you're going to see a lot of the do-it-yourself Robin Hooders.
There was
looking.
do-it-yourself investors before Robinhood, right?
Yes.
Okay.
Yes, but it's Robin Hood is the sign of a peak. So I think that's about it today, Wesley.
I think so too.
Okay, well, Bill should be back in the saddle with us next Friday. Thank you for helping me out today and filling in. And I hope everybody has a fantastic weekend. It's very chilly here.
Yes.
Stay warm.
Go Niners.
See you next time.
Go Niners.